Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.
First off, before we get to today's episode, I'm not okay. If you followed and listened to this podcast, you probably know that not only am I Jewish, I have Israeli family on both sides, and I love being Jewish and our culture with all my being. Following last week's horrific attack by Hamas, a terrorist organization in Israel, on innocent civilians, to be honest, it's hard to think about anything else. Thankfully, our families in Israel are safe. With every morsel of my being, I condemn Hamas, and I stand firmly with my Jewish brothers and sisters in Israel and in the diaspora. I pray for peace. I pray for love. I pray for humanity. And I pray that the good of humanity will prevail. So with that, welcome to the Planet MicroCap Podcast. I am your host, Robert Kraft. I do thank you all so much for the support, for everything, and for tuning in. And do me a quick favor, if you like what you hear here at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engines so that more folks can also discover and engage with all things microcap stocks. Next up is the Planet MicroCap Showcase Vegas. That's happening April 30 through May 2nd, 2024 at the Paris Hotel and Casino. Save the date. We are working our tail off behind the scenes to put together the best program that we can. Some really, really cool conversations with some incredible thought leaders. The website is now live, and if you'd like to register to participate, please visit planetmicrocapshowcase.com. See you in Vegas. My guest on the show today is David Bastian, Chief Investment Officer at Kingdom Capital Advisors. I met David at Ian Cassel's MicroCap Leadership Summit a couple weeks ago, where he brought the house down with his comical, albeit serious, pitch on the Children's Place, a publicly traded company. The symbol is PLCE. Safe to say, David was tailor-made to be a great guest on my podcast, and he does not disappoint. In our conversation, we talk about quirky, off-the-beaten-path investing, what that means, understanding when to make your move when assessing these quirky stocks, and quick pitches on the Children's Place and national CineMedia. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my interview with David Bastion.
David, thank you for joining me today. How you doing, man?
Doing well. Thanks for having me on, Bobby.
Absolutely. It's great to have you. I mean, look, I think I've been following you for a little bit on Twitter, but my first time meeting you or seeing you speak was we were at Ian's MicroCap Club Investor Summit or Leadership Summit, where you brought the house down in your 10-minute pitch on a PLCE. I think everybody collectively was like, that was best pitch or not. It was just by far the most entertaining. For sure. So, I mean, that I had to have you on after that, man, because that was just too good.
Oh, thanks, man. That was fun. Children's Place isn't that exciting of a business, so I had to try and keep the pitch a little more interesting and keep everyone's attention. So,
see, I just assumed that each one of your pitches were probably going to be like that, even or like now I just know, like, okay, if it's an exciting business, that's really, really cool. Like you're just like, yeah, whatever. It's just like, whatever, just it's growing at this rate, and hits all the like. I'm just assuming that's how you just do it from now on, right? That's the thought process?
you got to balance excitement of business with excitement of pitch and keep everything in equilibrium.
Just not only that, keep it equally, but keep people on their toes. Like, wow, I was so excited about this. He's pitching this and he doesn't sound that stoked. Versus like, oh, this is like kind of a boring business, but here he is, like the most excited person you've ever met in your life. Like, this is great. So I do appreciate that. But kind of before we get into kind of the nitty gritty of like your style, all that kind of stuff, for folks that don't follow you yet on Twitter or anything like that, I haven't read any of your letters. Love to get your background. How'd you get in the whole game?
Sure. So prior to starting Kingdom Capital, I was working at PricewaterhouseCoopers doing mergers and acquisitions, due diligence work. Essentially working in the small and mid-cap space, helping private equity buy and sell companies. So got me pretty familiar with evaluating businesses and thinking about what are good opportunities, what aren't. So I started trying to invest on the side and figure out if I could, go and do that and find a way to go make this work as a full-time job, and that went well. So I was able to hit escape velocity and launch January of last year. So almost up to 2 years of Kingdom Capital, and it's been a lot of fun. I'm really enjoying it, and I'm glad that I get to do this full-time now.
Listen, I'm glad you're having a lot of fun and starting a microcap strategy about 2 years ago. So that if that says nothing else, then it's truly for love of the game.
It's been a bit of a bloodbath out there. Landmines everywhere.
That's without question. So, even from that experience, I mean, I'm sure it's clear to most, like how you eventually arrive the small microcaps. But I mean, for your purposes, and also maybe you can explain the strategy for Kingdom Capital. How did you then say like, all right, small micro, that's where we want to go?
Sure. Seems like, as you and I both know, if you're in the small microcap space, there's a lot of really bad businesses and things you don't want to own. So it is tough in that regard. But I like the idea of looking at stuff where I had less competition, and the smaller companies were generally where I was seeing that. So markets are mostly rational and efficient. They get inefficient with large caps, they get inefficient with small caps, but I thought I had the best chance of being able to find an edge on smaller stuff. I think when you get into the large caps, people at least have better data and have more access, and that's something you can't really get when you're starting out as a smaller investor. So I like being able to do a little bit more on the smaller side and find some weird, quirky, boring businesses, depending on what we're looking at.
For sure. All right, so let's give some of your criteria. I mean, actually, I'm going to ask you like this. I mean, prior to starting Kingdom Capital and then now 2 years in, would you say has your criteria changed at all from going full-time private investor to then launching the fund?
Sure. I think it's an evolving process, as you know.
Of course.
You're constantly learning. I would say maybe the biggest thing that's changed for me in the last couple of years has been really increasing my weighting of the management team I'm investing alongside of. I think I used to have more of like more of a simple like thumbs up, thumbs down of like how good are these guys? Are they good enough to invest with or not? And I think consistently some of my worst investing experiences have come from management teams where I kind of was holding my nose to get involved. And so at least personally, that's something that I think I was underweighting in the past, and I've had to grow a little bit more selective in who are the people running the company that I'm investing in. Maybe that sounds obvious, but I've at least had to increase the weight of that compared to some prior investment decisions since I launched.
Absolutely. I mean, look, it's tough, man. Look, I was just, not only did we hear a bunch of management teams at Ian's conference, Vancouver, he did our event at the beginning of September. And then we're recording this on Thursday, October 12th. I was just at Paul Andreola and Trevor's show at the Small Cap Discovery show yesterday. And, it's that traditional format where you get to hear, everybody do their corporate presentation for 30 minutes. And that was kind of one of my first times I've gotten to do that in a long time. Just sat there and listening to, I think I listened to like eight presentations, something like that. And it's still, I've been doing this 12 years. It's still difficult, right? Because once you get into the one-on-ones, like that's when you get to know them a little bit better. And, and you always have to have, like Ian even talked about in his presentation, like one of his biases that he always has to work on is the idea of like, not becoming too close or having management becoming friends. That is so difficult because on a human level, like you want to relate, right? You want to interact. And also you just feel like from a business side of things, like, oh, like this seems obvious. Right. Like we want to get to know them as well as possible. And as a result, you're likely going to become friends, in some capacity. So it's just, this sounds obvious to everyone listening to this. And I know I sound like a broken record for now, like 8 years of doing the podcast, but like, it's friggin' hard, dude. It is. Like sometimes you just need that reminder too, when you just sit there, you hear those presentations. Some of them are really good. Some of them are really bad, but the businesses are interesting. And and you have to be able to disassociate, like, all right, maybe they're just a bad presenter versus, it's the fun of it, at least for me.
Yeah.
I'm sure.
Yeah, no, it's one of the hardest things to quantify too, because you can only get to know management teams so well starting out too. So you gotta figure out what you're looking for and then figure out how to quantify that into, how far you're willing to go investing with them. So it's an art.
Yeah, absolutely. All right. So what's your, look, like I said, we're talking October 12, 2023. We're still in the middle of this microcap bloodbath, even though like some of the more quality names have been doing not too bad. I mean, I'm looking at some of the charts for some of the companies that presented yesterday. Like there's about half of them that are up probably 30-40% on the year, which that's, you can't sniff, you're not going to hold our nose up to that. But, how are you approaching to markets right now? What's your criteria? Love to hear more there.
Sure. So I think if I was trying to think of like 3 big things that we're looking for, it's not required, but the more quirky or off the beaten path or the less familiar the investing community is with something, that's got me interested right now. If something is really cashed up and cash flowing a lot, that's something I'm very interested in. And then just misunderstood stuff that has a catalyst. That's stuff I'm very interested in. I can give you a few examples. So we'll talk about cash first. There's a Unit Corporation, ticker UNTC. I own this. This is a exploration and production oil and gas company. Objectively not a great business. Most people that have invested in energy understand that you can have a really terrible experience over there. This company went bankrupt in 2020 after prices crashed during COVID. Wiped out their debt, reorganized, came public again, and they have just really focused on cash flow. And they have done a remarkable job. The stock is up from single digits to today. It's about $53. They have paid out $15 of dividends per share just this year. Again, this is a $53 stock. So they are returning capital. They bought back 3 million of the 13 million shares they had outstanding, I think, when they came out of bankruptcy. So they're doing buybacks. They're paying dividends. They have $200 million of cash sitting in the bank right now for a 500 million market cap, and they're cash flowing, around 100 to 150 million dollars at the current curve for oil and gas, and operating some drilling rigs that they own. So it's not that exciting of a business. I don't think this is a future 10 bagger. I think it's just very cashed up. I think they're managing it much better than it was managed prior to the bankruptcy in 2020. And it's OTC, it's off the radar. This one I think is at least more understood than some of the stuff I own. Like there's pitches on Value Investors Club, it's on MicroCap Club, it's on Twitter, and a few different people are following it on there. So it's got some coverage. But there's a lot of cash there, and they're allocating it well. They're distributing it to shareholders, and that's a hard way to get killed right now in what is otherwise a pretty tough market. So that's one that I look at. I really like the cash flow profile there. For kind of quirky stuff, use the example A-Mark Precious Metals.
Remember that
these
one?
This is one I've been involved with since 2020. These are bullion dealer. They're primarily a wholesaler of gold and silver. I ran across it a couple of months before COVID hit, and my takeaway was, oh, this is the kind of company I'd really want to own if everything really starts going sideways and people are scared and they're buying gold and silver. And then like 2 months later, COVID's happening, and I was like, I need to be going and buying shares of A-Mark. This is seems like their ideal market environment. And it was. The stock was like $8 a share at that time, which was pre-split. So $4 adjusted now, and the thing trades at $29 today. What I really liked about A-Mark, and one of the reasons I've stuck with it, I still own some, is they did a really good job of taking what was windfall profits and high grading their business. So they went out in the beginning of 21 and bought the largest direct-to-consumer gold and silver brand, which is JM Bullion. They already had a relationship with these guys. They brought them in-house. And if you go back and look at their legacy business, it was like a 0.5% margin wholesale in good times. Terrible margins in this business. They went out and bought direct-to-consumer brands that, you saw these stuff operating anywhere in the 5 to 10% gross margin range. So just went out and bought a lot of stuff that improved the quality of the earnings in their business. And, people looked at it and thought, this business is going to revert back to pre-COVID levels. But, they've gone out and done things with their capital to try and kind of build a larger moat around their business. They bought some mints to help control supply in the industry. They bought some other brands. They made some minority investments and stuff. So Quirky, there's no public comps for it. Not a lot of people are looking at this thing. It's a stock that's not really correlated to the broader market and does well in times where things are bad, which I think all of us want to have stuff like that helps us ride out the tougher times in the market. So that's been a fun one to keep up with. I bought a ton of it again back in March when the bank runs were happening. And you can go on their website and you can see stuff related to demand and spreads for what they own. And it was just blowing out to the upside, and the stock wasn't moving for like a week or two. And I was like, oh, I know this business pretty well. And this is like their absolute best environment to operate in is banks are failing. People are buying gold. And that's what was happening. No one cared.
Yeah, so, I was going to say, look at that chart from, what was that? Oh my goodness. Yeah. From like end of February or like beginning of March through. Yeah. Nice. Yep.
Yeah. And we're right back where we started now because spreads contracted. Yeah. And again, that started happening before the stock crash. So there was kind of a window where you started seeing like, oh, things are getting worse, like exit stage right.
Yeah.
So I like stuff like that you can find things that are happening before the stock reacts. Go for it.
Yeah, real quick. And maybe you can use another example with this question because that's the goal I think of most investors. It's like they want to do exactly what you're doing, right? Is like, man, I want to be able to find that quirky off the beaten path. Like, do I just start with something that's just absolutely hated right now? And there's no like that I think about that all the time of like, all right, where do I go to just look, because that's the fun stuff, especially as a microcap investor, is like, I want to go where it's just quirky. I want to go where it's off the beaten path. I want to go where, things are either just really hated, moderately hated, and try and better understand why. So what's your process to finding that? And then also, what are some of your sources, or what do you think about, like, what's your thought process? And then, what are some of your inflection points where you're finally like, all right, I'm ready to make a move on this that literally everybody else hates or finds quirky or off the beaten path?
Yeah. So I don't remember who the quote's from, but there's somebody out there I've heard say that there's no bonus points for complexity. So I think I would be careful to say that when I say quirky, I don't mean stuff that's really hard to understand.
It's a really good point.
Because I've tried that. A great example of getting that wrong, or at least a situation that has not benefited me yet. Have you ever run across Wheeler Real Estate Investment Trust?
Oh, yeah. WHLR, right?
Yeah, everyone's favorite, 3 million market cap with $750 million of other securities outstanding.
Yep.
Incredibly complex capital stack, messy situation. I have spent a lot of time on that thing trying to figure out ways to make money off of it, and I have gotten nowhere. It is complex and has not benefited me. I hope that someday there's going to be an obvious trade and I'll know what it is based on the time I've spent with that. But man, complex and just absolute waste of my time so far. But but yeah, I don't know anything with it right now. I just track it, and like this thing has been an absolute disaster in the public markets. But maybe someday I will benefit from understanding it. So that's one where, yeah, complex, not worth my time, or at least not yet. So yeah, I think I like stuff like that. But I just have to remind myself that, again, I'm not going to be rewarded for really understanding a complex situation if there isn't any catalyst for it becoming less complex or other people figuring it out easily, because that usually stocks don't become much better understood on their own. Just impromptu moment, it doesn't happen. I think one I did benefit from last year, there's a funny other oil and gas company called W&T Offshore. They do Gulf of Mexico production. These guys are funny. They're kind of the opposite of Unit in terms of like really conservatively run, really like, I mean, these guys are more of their E&P cowboy types that you're looking for in that market. They had went and bought some more assets, and the bank that lent them the money forced them to hedge a bunch of their production when they bought them to try and lock in some level of certainty around getting repaid. And they didn't like that. So they went out and bought calls on natural gas to try and offset their hedging book, because they didn't want to not get upside price exposure when they were hedging their natural gas like under $3 in 2021. Well, then last year, natural gas pricing is just blowing out to the upside, and these guys are a producer that went and bought calls on the thing they're producing. So I think they spent like $10 million buying the call book and they ended up flipping it for like $200 million after the fact. And it was an asset that didn't really show up on their balance sheet in a way that, because they had all these other things offsetting it, it wasn't really there. In terms of you would just like pull up the financials and be like, oh wow, these guys have a huge like asset that they're going to go monetize. But there was some refinancing risk around the company, and they had these calls that were going to allow them to refinance. And so when they monetized them, all of a sudden refinancing wasn't difficult. They were able to get new debt. Everything was fine. And the stock really exploded to the upside. And it was just, it wasn't that complex, but it was quirky. And if you weren't looking for it, you missed it. So that was one where, again, just kind of putting it in the basket of, oh, these guys have huge exposure to upside in natural gas. If natural gas starts blowing out, I'm going to go buy some, because it did, and the stock didn't follow right away. It played catch up. Yeah, so weird stuff like that. Again, playing in the smaller space, you find things like that. So yeah, trying to find weird but not too complex. If that makes sense.
Makes total sense. Real quick, just wanting to be totally sure. I was not a shareholder in Wheeler and not a shareholder in, it was WT, right?
Correct. WTI, yeah.
WTI, that's right.
Not either at the moment.
Got it. Yeah, I mean, it's fun, right? Because in some ways, like that's why we go on social media. That's why we're part of all these clubs. Like, because sometimes somebody might inspire you to start looking, maybe not necessarily at that one company in particular, but maybe just a swath or that one sector or that one industry, and then you kind of go down the rabbit hole and maybe you find a different opportunity that meets your investing style better maybe than that one company that had been talking about it. So maybe let's go down that road. It's like, all right, bottom up versus kind of top down type investing when you're trying to find, the quirks and the off the beaten stuff. That's the focus of today, right? Like, look, let's just go there. I mean, look, you talk PLCE everybody was like, oh, okay. Like, here we go. So, love to hear your thoughts on that, top down versus bottom up type of research process.
Absolutely. So yeah, my idea generation process, it really does look a lot like just having a list of names that I try to stay close to and knowing when things happen that should make me pay attention. Children's Place, like you mentioned, PLC, it's something I own right now. I've got a friend who used to work at a retail hedge fund and has known these guys for 15 years. And so he was the one kind of beating me over the head with this one, like, hey, you really got to pick this back up. They have an opportunity here. This is your kind of stock. And so having, just having stuff you're familiar with and then having other people you talk to who know business as well, and can kind of help, remind you like, hey, this is the time to be looking at this thing. So Children's Place, the pitch is out there. It's on my Twitter. I think MicroCap Club's Twitter put it out there about a week ago. You can hear my 10-minute riff on that from their summit.
It's 10-minute comedy bit. No, I'm sorry.
Anyway. Yeah. No, they sell kids clothes. It's not that complex of a business again. But I think if you pull up their financials, I think a lot of people would rightfully glance at them and be like, why would you buy this business right now? The debt's blown out to the upside. The margins are shrinking. Like the stock price has gotten hammered. Like this thing looks like it's going to file for bankruptcy in like 12 months. And I understand that's what you would see if you looked at it. I think people don't realize, like, yes, there's been a lot of retailers that are struggling right now. There's a lot of guys who screwed up inventory during the post-COVID, bullwhip return to normal. Everyone trying to figure all that out. Children's Place was hit harder than most due to their exposure to cotton pricing and their freight hit that they took in 2022. So if you read the company's transcripts, you'll see they had $125 million of extra expense in 2022 related to cotton and freight that showed up in their P&L and blew out their working capital. But you can track both those things and they're back to normal. Cotton's come back down, freight's come back down. They're working through their old expensive inventory, which has suppressed margins. And all of a sudden, like the margins are back to where they should be. And they've told you that they're going to earn $5 a share in the second half of this year. And I think they're going to guide to something, 5 or greater next year for the full year for the business. And I don't think the stock will keep trading at $25 if they're going to earn $10 a share over the next 18 months. Now, I could be wrong, but this is a business that generated $100+ million of free cash flow almost every year from 2009 to 2020 until COVID hit. It's been pretty steady. They seem to be run fairly well. They take excess cash flow and they do buybacks. They have some other levers they can pull to improve the business. I mean, because their online sales grew so fast during COVID, they had to bring a third party in to help them out with warehousing and fulfillment on their online orders. And they've got a project underway to expand their distribution center that they own in Alabama. Once that's expanded, they can bring it back in-house. They can reduce inventory again. They'll improve margins. Self-help. And I like stuff like that where you don't really see that in the numbers. If you're not paying attention, you don't see it coming. But I think the industry can get worse and they can be okay because they have levers to pull that'll help them out. Their leverage looks bad. I think they've guided to it being back down to about $200 million in net debt at the end of the year, even though it was close to $400 million at the end of Q2. They seasonally have a bunch of sales in Q3, so that's going to help with them finally working through all that. But it looks bad right now on a screener. So I think that's why it's misunderstood. I think retail is not a very loved sector right now, but I think these guys have the levers to pull that they can save themselves and go make a bunch of money. So I think they can generate a lot of cash whether or not the economy's good. I think it's pretty interesting.
Very cool. No, thanks for the quick wrap on that too. It was funny when you're doing your presentation, I was focused more on the business itself because, I got 2 kids, right? Almost 4 and almost 2. And yep. I at the time I hadn't heard of children. I mean, look, my wife, I'm not trying to put out the, the gender roles or anything like that, but in our household, my wife happens to buy most of the clothes for the kids. And so in my mind, I was like, wait, why do I not know about Children's Place? Like Carter's that's always the first thing that comes up, yep. And to be fair, it's pretty decently priced. And if it's my kids for a very long time. So in terms of just competitive analysis, when you think about Children's Place, and I didn't think we were going to do a full Children's Place pop, but we could do that too.
Yeah.
What's the fundamental difference? Just going through their website and looking at all the stuff, what's the fundamental difference between Children's Place and their brands versus a Carter's?
Sure. Carter's is a little bit higher price point in the market than Children's Place is. They over-index in the Northeast and West Coast. So Carter's has more exposure to, I guess, just in general investing types. Carter's is focused on their stores as a customer acquisition channel. Children's Place is not. So the quality of the stores is better at Carter's. You can check your local Google reviews if you doubt me on that. Overall, Children's Place is focused on customer acquisition through their online channel. They target millennial moms. So if you're not a millennial mom, there's a good chance you haven't gotten their ads. Or unless you're me and you've gone to their website to check prices and stuff, and now you get them all the time. But yeah, they're really focused on the digital customer acquisition. They're not as focused on trying to get your grandma to come in and buy stuff for the grandkids. It's a different business model. If you look at kind of one of the ways that I've been keeping an eye on them has been looking at their same store sales versus Carter's. Because that's trying to think about, all right, like things have been crazy coming out of COVID. Is there evidence that they are losing market share, that customers are choosing Carter's over them? You can go pull that up. They've been very similar coming out of that. So I don't think there's any real issues here of losing customers. Carter's is focused on wholesale more. They're in Walmart, they're in Target, they're in Kohl's. Children's Place isn't in any of those stores. They do some wholesale into Amazon, but most of their sales are through their stores, and about 40% are through their website. So again, it's more online oriented. They're not focused on the brick and mortar nearly as much. They have a smaller store base than Carter's. So they have a different target audience. They have a lower price point. I've recently had people asking me, oh, it was like Shein or Temu or some of these, Chinese e-commerce businesses that have really blown up here in the U.S. in the last few months. Those are a threat to Children's Place. But you can go compare prices between their websites. Like Children's Place is competitive on pricing with them. It's like, oh, you can get your pair of kids' jeans for $12 on Temu or $13.99 on Children's Place or something like that. It's not. They're not getting undercut on price there the way that some of the higher U.S. labels might be. So, that's another thing that I'm keeping an eye on. Maybe Temu starts to take market share. I don't think so as much. They had some quality, both with like chemicals and lead and asbestos and stuff that, I think there's less of a chance people are going to want to buy that and put that on their kids. But I don't know. That's just me. So.
Yeah, no, I'm with you. I'd prefer not to put like chemicals and lead on my children and not on their clothes. That would be ideal. What? Two questions. The Gymboree acquisition, was that the whole idea around that was because they're trying to target that millennial parent? Because I mean, look, I'm 34. Like my parents used to take me to Gymboree. Like I didn't even know they had a friggin' clothing line until your presentation. I was like, I was shocked. I was like, yeah. I think I was like, Gymboree, like what, like where's the gym? Like it's gotten taken over by my gym out here, right in LA. So like when I heard that, I was like, oh, Gymboree, they got clothes now. Okay, this is interesting.
Yeah, so Gymboree and Children's Place were targeting a very similar customer base. They were competing on price in 2018 and 2019 while Gymboree was really struggling, and Children's Place made the decision to essentially compete them out of business. And they did that. They filed for bankruptcy in 2019, and Children's Place bought the brand for about $75 million. So that's one of the other things that I like here is that if you're like me, you pull up a business, you look at how they're doing, and then you pull up 2019 and you try and figure out how much this thing changed during COVID and try to figure out if we get run over by a COVID winner or loser somehow here. Children's Places 2018, 2019 weren't that good. Those years they were under pressure from Gymboree liquidating, and they're fairly similarly sized businesses. And so them both discounting and kind of competing towards the bottom there was not great for them. So they did have some competitive pressure there. Gross margin was down a couple hundred basis points. And so you can look at that, and again, without doing any industry research, and think like, oh, this business was already declining going into COVID. It's like, well, it had a competitive pressure in 18 and 19. They took it out. Something else could pop up. I mean, this is a tough industry. I don't want to pretend that other things can't go wrong, but I think I like stuff like that where there's even more of an explanation for like, hey, like 19 wasn't that great of a year for these guys. That may not be the baseline. 2020 probably would have been a much better year for them ex-COVID, but we'll never know because COVID happened.
So, just to kind of wrap up on Children's Place, you kind of alluded to this, but what would you say is your primary thesis where, all right, this is why I'm going to be holding what's your ideal holding period for this? And what would you say is that main thesis would be for ultimately like, all right, time to sell. Like I got what I expected out of this.
Sure. So I would say for Children's Place, you got a stock that's trading at about a $300 million market cap. And I still think that normalized free cash flow for this business is around $100 million. They got $200 million in net debt by the end of the year if they hit their guidance. I think that's an acceptable level of debt for a company like this. They may pay it down a little bit more. So, yeah, I'm looking at that and I'm saying, all right, for a company that has historically done buybacks with their excess cash flow, 33% yield on equity doesn't make a whole lot of sense. So I'm looking for that to get back to more of a normalized 10% range for these guys. That happens one of two ways. It happens by finding out that free cash flow is going to be lower than $100 million, in which case, I've got to readjust my expectations for stock price. And the other way is finding out that the stock price shouldn't be $25 and they start doing buybacks and it has to respond accordingly. So, one of those two things will happen next year. Either I'll find out I'm wrong about cash flow, or people that were selling the stock at $25 will find out that they were wrong about the business being permanently impaired. So we'll see.
We shall see. So another question I wanted to ask you today, yesterday I was at the conference yesterday, so kind of was like barely scrolling through and didn't really see the update. But I guess Tesla, I saw you posted about this, about Expel, which is our beacon of hope in the microcap space in terms of like cult microcaps that made it out of here, at least of the last 7-8 years. What was this news that Tesla is now offering wraps for the Model 3Y for what is that, like about 7,500, $8,000? And of course, that's Expel's business. So love to get your comment on that. I mean, that's that definitely Expel Twitter was going nuts yesterday. So let's hear about it.
Yeah, no, there's a lot of takes on that, and I'll quickly note that I know less about Expel than a lot of other guys on Twitter. So Jason Hirschman and
I was gonna say I didn't listen. Jason did this for the long haul. He's probably okay. Yeah. So, but anyways, go.
He's got a tweet out there on it, so definitely check that out. My understanding is Tesla's starting to do this at two of their facilities. The fear here was always that there was going to be some level of auto competition with Expel. The belief is that they have a strong enough moat in their relationships with dealers and suppliers that they weren't going to be able to be disrupted. And so the idea that Tesla is coming for them on this product scared some people, and the stock sold off 20% yesterday. I think my understanding is their moat is probably stronger than Tesla having it at two facilities. I think the fear here is more related to what does this mean for their growth? Do other people try to do this? How successful is it going to be? Someone's finally actually coming for them, I guess, would be the fear. They put out an 8K this morning, which was worded to suggest that Tesla is 5% of their business. The way it's worded might make you think that it's more than 5% of their business, and they try to very carefully select words to make it so it sounds like 5. I'm not sure. I looked at that, and that's one that's well known in the microcap land. It's a little bit less off the beaten path than I would like. So, watching all that happen yesterday, I was like, I don't know this business well enough to go buy some stock and know that this isn't a big deal, or short it because I know this really is. I'm staying out of it for now. I will say I heard Ryan, the CEO, speak at the MicroCap Club Summit, and he seems like the kind of CEO that I would want to run through a wall for. So,
1,000%. Yep.
If there's somebody that you wanted to lead your company through next round of Tesla competition, I think he'd be the guy. So I would not want to bet against Ryan Pape over there. So I think they've got a good guy at the helm to manage through whatever this round of fear ends up being.
Absolutely. No, that's a good place. Listen, I'll get Jason on at some point. That would be kind of fun to do. Well, I don't know if fun is the right word, but it'd be interesting to get a quick take on some of this. Oh no, an existential crisis here. So, by the way, full disclosure, not a shareholder in Tesla or Expel. David, just quick disclosure, neither.
No, nothing.
Very cool.
Not touching either.
So getting back to our talk on like Quirky, off the beaten path, all that kind of stuff, kind of to close out that conversation. I mean, look, we're in a microcap, small cap environment that is still, just for lack of a better term, it's just been rough, right? It's just crap. It's crap. So there's a lot of different off the beaten path Quirky. Listen, I'm at this conference yesterday. Here, I'll pull it up. I got, what is this? I got a, aerospace, defense, and electronics. We got, a concrete farming products manufacturer. There's a couple of energy services. Oh, look, a cannabis, proprietary extraction technology. Look, the trust company. Yeah, of course, everybody. I'm sure everybody realized Atlas was there presenting yesterday, not a shareholder. Mobile internet of things. Like there's so many different roads to go down right now in microcap, and it's just kind of trying to pick which rabbit hole you want to actually dedicate your focus to and not just get lost in something that maybe, isn't that interesting right now. So like, how do you truly discern from, especially right now, like, okay, this is where I want to allocate my time. This is where like interesting, but maybe I'll say that for a fun weekend read.
Ooh, yeah, that's a good one. I'm definitely speaking, I mentioned earlier that I've started to put more focus on companies that have good management teams. I think another area that I've learned to focus more on is companies that have specific improvement coming down the line. I've had a horrible time, like most microcap investors, trying to catch falling knives when you look at a business and say, oh, things are going to get really bad here before they get good again. But everyone knows that, so it's priced in. And it's usually not priced in, especially in this environment. I don't think a lot of people have patience right now for a bad quarter or for any kind of deceleration in results. So, depending on your time horizon, depending on what you own and why you own it, I've like long-term taxable gains are better. It is great to be involved with something where you know it really well and you're not worried about a specific quarter. But that doesn't always mean you want to just sit there and take a huge drawdown because it's coming. So I do my best to step out of the way of freight trains when I see them coming. I think Children's Place is a great example of one where I've owned it this year and just thought market is going to see all this stuff that's coming down in the second half. They're going to earn a ton of money. Things are going to improve. Like this stock's a steal at $30. And then all of a sudden it was $15 in May. I'm like, all right, I guess it wasn't a steal at $30 or it wasn't as much as it is now. So I got that one wrong. I thought that like they're guided to this. The improvement's right there. I don't want to wait and have to buy it at 50. Well, I could have bought it at 15. Learned that the hard way. But yes, anything where I can see clear path to improving results or growth, new opportunities, improving balance sheets, whatever it is, I'm definitely spending more time on that and not trying to estimate, things can only get so bad for ticker XYZ. Because, like I said with Children's Place, that's been one of the stark reminders. We talked about A-Mark earlier. They had a really good window of business earlier this year, and it's right back where it was where I was buying it in March because the window was good. It closed and everyone left. So getting out of the way of stuff that's decelerating has definitely been one of the themes of this year, I think.
Absolutely. No, that's some good stuff right there. So, one more name I wanted to ask you about because it's actually shown up in our index. I think two out of the 3 or 4 quarters so far in 2023, just based on some of our proprietary performance, was National CineMedia. You wrote that up on Seeking Alpha. I mean, look, the theater space it's super interesting right now. Just from an interest perspective, like trying to better understand like where entertainment industry is going. Like, there's a clear bet here on peak TV being done, right? And now that maybe some of that intellectual capacity is now geared more towards creating more quality movies versus TV that just doesn't make anybody any money. So just curious as to your thesis on National CineMedia. I'm not a shareholder, but just interested in your thesis and then also your overall take on the industry.
Sure. That's a really fun one. I don't own it right now. I really wish I had held it longer coming out of bankruptcy. Very interesting stock. So these guys, first, hat tip to management. Before they filed for bankruptcy this year, last year they pulled off one of the more interesting things I've seen in the small cap space, where they went out into the open market and bought back some of their secured bonds. So this is really cool. If you figured this out, you made a bunch of money earlier this year. Essentially, there was an Up-C structure at the company where they have like a holding company that was owned partially by shareholders and partially by like AMC and Regal and Cinemark. And then there's like the actual advertising business that they're all, that has the debt and things like that. So the subsidiary is what filed for bankruptcy, but you're a shareholder in the Up-C company. that owns secured debt in the company that just filed for bankruptcy. So because they bought their own secured debt at the holdco, then when they filed, you as a shareholder were a senior secured creditor of the company that filed for bankruptcy, and not just a common shareholder of a company that went bankrupt. So you had a really funny scenario where the subordinated debt essentially got zeroed. They got a few dollars, but essentially zeroed. And the common shareholders got interest in the new company because they were senior secured debt holders. So that was an example of complexity where it really paid to understand what was going on, because instead of the equity being a zero, like you would expect in a filing like that, if you bought shares in NCMI, you continue to own shares in NCMI post reorg. And this is a business that historically was run with about $1 billion of debt sitting on it. And then they came out with a clean $350 million market cap and practically no debt, trading at about 7 times their forecast EBITDA for the year. So very interesting little business. They had to renegotiate some of their advertising leases. What they do is run ads before movies at the big threes movie theaters and then some other smaller cinemas. And they kind of have a monopoly on the industry. So it's a fairly high quality business. It's fairly high margin. They were able to run with so much debt because it was a very predictable and seemingly stable business. And then COVID happened, all the theaters shut down, and these guys ran into problems. So yes, all that backstory, come out 7 times, no debt. The real question there is, all right, is this a dying industry? And not only are theaters dying, but you're also trying to figure out, is the way that theaters are being interacted with dying? You and I can go to a movie theater and buy tickets ahead of time on our phone for the most part and reserve a seat, depending on what theaters are around you. Some do this, some don't, but it's become more and more of a trend. So there's people that look at that and say, selling ads into a theater, if it's going to have reserved seating and everyone's going to walk in right about the time the ads are done, that's not like that business is going to die because people aren't going to be sitting there for 30 minutes so they can get good seats.
I don't know. I always like to think from personal experience, like what my user experience would be. And right. I don't know, I don't know if you're like me, I like seeing the previews. I mean, I get it. Okay, you're talking about like before the previews even start, right? That's where the ads come in, but
you get your local car dealers and orthodontists and stuff are like running ads. And so I mean, there's a mix. They still have some stuff in there. They have like a marquee ad spot that they usually put in there with the trailers. So, this isn't to say this business is going away so much as is it going to be nearly as good of a business as it's been previously. And so, buying something that's an effective monopoly at 7 times earnings with no debt, like there are worse ideas. So I think that was what made the opportunity interesting coming out of bankruptcy. And it quickly doubled with the share price that they were sitting at when they came out. And you had the Barbie Oppenheimer weekend that was like theaters are back, they're not dead, everything's fine. And so then you got a big wave of that. And then the writers went on strike and there might be no movies next year. And all of a sudden theaters were not back. So it's a really interesting one. There's a lot of moving parts. So I think that's an interesting dive for anybody that wants to say like, hey, this might be a really high quality business trading at a price that historically is much cheaper than it's been.
And there could be that tailwind of peak TV. Like, I don't know, I listen to The Town, that podcast a lot. Yeah, I don't know if you heard that one with Matthew Bellany. And they've done a few episodes about the idea of peak TV being done. And the whole correlation there is like, okay, like I said, there's some of the, there is this 10-year period here where the best writers and best directors were like, hey, the real money's in TV, because these streamers are just paying top dollar for the best names, the best writers, all that. We don't care, these development deals, and just spending indiscriminately so that they can have them, under their roof and only writing for their stream. Like, they're not going to do that anymore. Like, those are done. Those days are completely over. So I wonder if the pendulum then shifts back to movies. And like, as a result, like the audience will say, well, if there's no good TV, like, and it's now at the theaters, all right, maybe it's time that, we start going back to the theater. But then again, there's also the idea of like, all right, well, Well, I think the streamers would probably end up still, there's like that 45-day grace, but even Disney is like extended that, right? Like they used to have the 45 days and then the movie was available on Disney. It's like they're definitely not doing that anymore.
Yeah.
So
no, and that's, again, there's just a lot of moving parts in that world right now. I mean, that's a business that got, the way that COVID impacted there with the streamers, the movie theaters, there's a ton going on there. And so I think for anybody that spent a lot of time there and kind of understood the implications of what was going on with that business, you could have made a lot of money. And I think you still might be able to. I mean, if NCMI is a growth stock and not a cigar butt coming out of this filing, and trading it 7 times, I mean, they've got an opportunity to do some really cool things with capital allocation. I mean, if they flip a buyback on and start taking out some of these lenders that are in there that might not be natural shareholders, I mean, that's what happened with Unit Corporation. That's one of the things I loved about those guys was, they filed for bankruptcy. They had all these guys in there that, owned the bonds and weren't natural shareholders. And so they just came to them and were like, hey, we'll buy you out of your stock. They understood where the business was going. They were able to get a bunch of blocks off of people before, the earnings power of the business really became apparent. And I think NCMI might be able to do something similar. But we'll see. I don't know. But I think that's a really fun one.
Absolutely. I'll definitely, I'm gonna try and get hopefully I can get a due diligence interview with their CEO. That'd be really cool. Because at a minimum, just to hear about the industry and hear their takes, like I'm sure they're going to be bullish, no doubt, right? Like they probably have to be, but you never know. I could pull a little bit out of them and be like, come on, man, like I'm nervous a little bit, they're a little headwindy shit there. But all right, dude, I think, we covered a lot, man. I mean, any final thoughts, final takes, any on individual names, just investing in general, microcaps, life? I don't know, close us out here, man.
Oh man, this is a lot of fun. I think one of the things I really enjoy about investing is it's a team sport. For the most part, I like meeting guys like you, out at the MicroCap Club Summit, getting a chance to come on here and talk some names. There's a lot of good people to swap ideas with. You learn a lot of stuff. I think you can be a continuous learner in this world, and especially in investing, you get opportunities to see what works for people, what doesn't. You get to see, you can listen to a podcast where some guy comes on and is like, let me tell you why Warren Buffett's whole career was luck. Like, oh, wow. Okay. Like, that's a take. Like, there's so many different ways to do this, and people have all sorts of ways they make money. You can learn so much. I think for me, it's just been fun finding what works for me, finding stocks that I can get comfortable with, finding great people. You get to know really cool companies you never knew existed. You find yourself walking through a store and seeing something like, oh, I own like shares in that. I didn't know they existed until this year. Just fun stuff. I really enjoy getting to know these companies, getting to know management teams, getting to know other investors. And I'm really enjoying running my own fund. So, thanks for having me on. Always happy to talk small microcaps, and look forward to catching up again sometime.
100%. Well, before I let you go, where can folks go and find out more information about Kingdom Capital Advisors, as well as follow you on social media?
Sure. So I've got a Twitter account, which is at KingdomCapADV. I'm on Seeking Alpha a decent amount. That was kind of the first platform I was able to get some ideas published on and get my start there. So I still put some theses up there. I hang out on MicroCap Club, so shout out to them. If you can go submit an idea or pay to get access to that, it's a really good community of like-minded microcap investors. And then my website is kingdomcapitaladvisors.com. We've got our fund letters up there and some of our prior, different media stuff we've done. So if you want to learn more about us, those are all great places to go.
Very cool. Well, David, thank you so much for joining me here today. Really do appreciate it. Good luck. Stay safe. Look forward to our next update, man.
Thanks, Bobby.
Thanks, man.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.